Okay, let's get started. Good afternoon, everyone. Parker Gerard here with Evolve Advisor Group. I got Michael Humbert on the call with us today from Kessler Investment Management. We are excited to talk through our Q2 market outlook, our Q2 review, and then market outlook through the rest of the year. Most of you on the call know me. I'm a financial advisor here at Evolve Advisor Group. I know we got a lot of folks on the call from different 401k plans. So maybe I've talked to you in the past, maybe I haven't. If I haven't, it's nice to see you all. And then Michael, I'll kick it over to you. You want to give us a quick intro on you and your background?
Yeah, absolutely. Thanks, Parker. Excited to be here with everybody today. My background, I've got about 17 years in asset and wealth management experience. The bulk of that career was actually spent in the beginning in private equity. I spent 10 years in the industry in various roles at firms like Blackstone and Starwood Capital. From there, I pivoted away from private equity towards public equities, where I spent 5 years as a equity product specialist at a firm called Dimensional Fund Advisors here in Austin, Texas. And in that capacity, I began to appreciate asset management, what I had been doing, working with institutional investors and wealth management, which has a high overlap. And then the difference there being the unique tastes, preferences, and bespoke needs that come into the wealth management conversation, the planning conversation. So I find that conversation to be really interesting. And we'll try to connect what we talk about here today in the quarterly market review to those themes that are applicable to you and to the individual investor as well.
Awesome. Yeah. No, thank you, Michael. It's been great to get to know you over the last couple years. So let's go ahead and dig in here. I just always like to start. Thank you to our compliance team at Kessler. You guys do a great job putting that together and keep it moving here. And what we'll do is we'll start with just a review of the second quarter. So we'll kind of start focused in, and then as we talk, we'll talk through some of the themes of the last quarter. So we'll talk through the markets. We'll talk through fixed income and the new our new Fed chair, Kevin Warsh, who will be talking here in just about 30 minutes. And then we're going to talk through one of the major themes of the quarter, which is really AI and technology. That was really one of the more exciting themes and where we've been receiving a lot of questions from clients and plan participants. And then we'll take a step back and look at markets really as a whole from a long-term view, which I think is really important. But digging in here to the second quarter, it was really a fantastic quarter. Really in most asset classes, U.S. markets up 15% in one quarter is really just tremendous. And this is coming off of a tough start to the year. Q1 was more or less flat, and so a great rebound here for U.S. markets. Emerging markets we see even outperforming U.S. up 24% in the quarter, and then developed ex-U.S. as well up to about 10%. Our fixed income markets, one of my colleagues, Sammy Collins, we were actually talking internally. He said fixed income was kind of boring for the quarter, and I said, that's pretty good. I want my fixed income to be boring. I don't want a lot of excitement in my bonds. I want the bonds to be nice and safe. But even with that, seeing 2.5% returns in a quarter for fixed income is really pretty strong as well. Commodities was really our only drawback on the quarter. Commodities, as we know, are soybeans and our precious metals, but also includes oil, and we saw a pullback in oil in Q2, so that explains some of that. Real estate up as well. But Michael, I mean, anything else you see here that really jumps out at you? Any other themes that you'd like to talk through?
Yeah, you put down so many threads that I would like to pick up. The first thing that you talked about, you use words like stellar and tremendous, and I couldn't agree any more strongly. Returns like 15% to U.S. equities in a quarter, represented by those gold bars on the screen. That is a phenomenal return. Emerging markets, we've seen very much playing out a similar theme of the tech, AI, CapEx, beneficiary trade, really driving some of the growth in that market in particular. Notably South Korea, notably Taiwan. They've had incredible returns. And developed markets outside of the U.S., nations like Japan, Australia, the Eurozone, obviously, UK, it's kind of like, oh, am I disappointed by a 10% return? And I probably don't have to say this to anybody on the call here, but nobody's retirement goals were derailed by the 10% return in a quarter. These are fantastic returns. Equities really served that growth of wealth function that they play in our portfolios. Transitioning to, well, what's fixed income's role in the portfolio? Parker, again, I love what you just said. I want my bonds to be boring. I was having a conversation with a friend. He's an equity research analyst. He's a bright guy. And he says, yeah, I don't buy bonds. Bonds are boring. What do you get? You get your yield along the way and then your principal back at the end. And I'm pausing and thinking, yeah, that's the trade of a bond. That's exactly what I
That's the
want.
point.
That's the point. That's exactly what I wanted to do. I don't want my fixed income piece going all over the place. I wanted to give me my yield, clip along, and then give me my par back. And so you're getting exactly that experience there in your fixed income. Talking about the role of a portfolio, trying to make it beyond the asset class a little bit here. Fixed income can serve many different functions in a portfolio. Equities are easy. What I've covered most of my career, equities, they're easy. Generally, it's the growth of wealth function. You want them to be worth more later. Fixed income can be a diversifier to your equity or other asset allocation. It can be required for the income needs that you have. It can be a ballast to your portfolio. It can be pursuing expected returns, like favoring something like high yield or lower credit quality securities, going out longer duration, whatever it might be. There's lots of ways to do that. So the fixed income piece is really important to your overall plan. But on the quarter, it did pretty much what we expected it to do. And then the last thread you put down, it's like you took all the words out of my mouth, Parker. The commodities piece was really the only bear in the room. And it's funny that you led with soybeans. I don't think a lot of people appreciate how much agriculture represents within the commodity index here. Now, soybeans did fine, and agriculture and the rest of the universe was kind of had its gives and takes. The narrative there really is oil, as we saw some oil price decline heading into the end of the quarter around optimism for a renewed peace deal. We'll talk about that a little bit later on, about where we've gone from the end of the quarter to where we are today, because it has shifted quite a little bit here. And it's a good reminder that year to date, Parker, these returns, it's quite a big shift.
No, yeah, and yeah, taking a look here at year-to-date returns, we're seeing really, if we look at the equity markets, U.S. markets up 10%, they were up 15% last quarter alone. All of the positive returns came in the second quarter. And Michael, this is something that we talk about a lot with clients, is that equity returns are not linear. I think historically we've seen where U.S. markets have given us about a 10% rate of return, but they almost never give us a 10% rate of return in a calendar year. Kind of like, I like to, for our sports fans on the call, I like to point out, like LeBron James, for instance, has averaged 27, 7, and 7 over his career, but I don't think he's ever had a game where he's had 27 points, 7 rebounds, and 7 assists. And so averages don't really tell the full story. And so this year is a great reminder of why we need to continue to be in the market, just because we don't really know when those returns are going to happen.
Yeah, I'll extend the sports analogy, to a different. If you maybe don't like basketball, maybe you do like tennis. Okay, so Roger Federer, one of the greatest players of all time, maybe the greatest, depending on how you view a few of the others there. Parker, how many points do you think Roger Federer won throughout his entire career? On a percentage basis? He's played, he's thousands and thousands. I'll spoil it for you. He won about 54% of his points. Now that translates into the greatest Wimbledon player ever. 78% of his matches, more than 80% of his games, more than 80% of his matches. That small advantage compounds over time. Stock market returns actually follow a fairly similar distribution. They're up more often than they're down, but not 6 out of 10, 7 out of 10 days. It's a little bit more than a coin flip. Just about that same 54% as Federer won in each of his points as well. And yet we see being in the market for the long pull, even just going from something like Q2 to year to date, you see the benefit of that, right? Look at the commodities piece. It was down 9% Q2, but up strongly on the year to date pieces period, excuse me. So with that in mind here, trying to I don't want to beat the sports analogies to death, but those small benefits, right? Staying in the market, because you have to capture these returns. They are not linear. They can happen in quite chunky, sudden periods, like they happened in Q2 of this year. This is a great reminder. This year is a great reminder for the benefit of staying committed and invested to a plan, because we don't know the distribution of returns, but when they happen, they're generally worth being in your seat to capture them, Parker.
Yep, absolutely. It's a great reminder. Now focusing a little closer here on equity sectors, we alluded to some of this, but really the quarter was driven by technology, and some of this AI trade. And again, these are the questions that we've been getting from our clients this year is questions around SpaceX and NVIDIA and semiconductors and data centers, and they can be very polarizing type of questions. But really, this is what led the market here in Q2 with information technology up close to 32% on the quarter, and really it was a breadth of performance that we saw on the quarter. So tech led the way, but we saw a lot of positive returns from most of our other sectors in Q2. Really just utilities, and then energy, although down 13% for the quarter, was giving back a lot of the gains in Q1. Energy really led in Q1 with some of that uncertainty in Iran and the Middle East and the rise of oil prices. So we gave up some of that in Q2. But Michael, I mean, it really jumps out at me the tech return of 32% on the quarter. It's really tremendous. But I mean, really good news across the quarter here.
Yeah, I think about it in aggregate, we got a 15% return from the S&P 500, and the distribution across sectors is presented on the screen here. But if you look at the individual names, about 338 of those 500 names contributed positively to the S&P's overall return. Wow. They had a positive return. If you same period last year, that number was sub 300. It was like 296, 295. And so that is a good sign as a portfolio manager. Something that I hope to see more of is broader breadth in the market, more names participating in that upside, and contributing positively to our growth of wealth function, to our return experience. And we saw that in this quarter. And so, yeah, a handful of names like in tech, again, drove some of that performance here. But we are seeing broader breadth. There are signs of a rotation happening, Parker, outside of just beyond the one note traditional AI hyperscalers play. Equity markets are rotating and broadening out who is participating in this upside, Parker.
Yep. Absolutely. Yeah. And we'll do a deeper dive on tech and AI here in a little bit, so we don't want to give it all away. Changing gears here a little bit into our fixed income market and the treasury curve. We had a new Fed chair this last quarter. So Kevin Warsh took over from Chair Powell, and inherited a lot of uncertainty with this conflict in Iran, leading to some inflationary concerns right off the bat. So it was kind of a tough time to transition. I always think being the chairman of the Fed is one of the hardest jobs in the world, and this was not a smooth time to be doing that transition. And we'll be digging a little bit deeper here on the Fed, but as of 14 minutes ago, actually, and Michael and I were joking beforehand, who decided to schedule this call during the exact time that the Fed would make a Fed decision. But the Fed did decide to not hike. They're holding steady right now. But we are seeing that the market is pricing in some hikes, and we'll explain this here in a little bit later. But Michael, I'll kick it over to you. I know you look at that 2-year part of the curve, the belly of the curve, and so I guess, why do you do that? What type of information does that tell you?
Yeah, I think so. Presented here, 2 yield curves, the darker blue line representing yields throughout the tenor of the curve, 1 month up to 30 years, the lighter blue line representing the end of the quarter here. And so you're seeing the change in that 6-month period between these two lines. Let me answer your question by setting up the stage. At the short end of the curve, right, that Fed rate that just went unchanged, what happened here? That's the Fed controls that one rate. That's really an overnight rate. They control the ultra short end of the curve. Every other rate on that curve reverberates from that moment, that starting point of the Fed rate, but reflects market participants' expectations for the future. And so you see things like at the 1 month and the ultra short end of the curve, they're pretty tight and pretty unchanged, right? Because there's not a lot of time risk associated with that. So they have greater certainty that yield and principal, whatever it might be, there's not a lot of reinvestment risk on the short end of the curve there. The long end of the curve represents these really long dated, difficult to grasp, highly uncertain considerations around what is long-term inflation, what is government spending, and our deficit going to have on that. That there's demographic information reflected in what that market expectation is. So it's pricing in a little bit higher expectations for yields, on the long pull as well. That belly of the curve that you alluded to is a good proxy, that 2-year, for inflation expectations over the near term. It's just kind of the sweet spot between ultra short, expectations where there is some uncertainty, but by the time nature of being 1 month or 3 months away, it's less. And then the long end of the curve, which is there's so much uncertainty, the discounted back nature of that uncertainty, it just means that it's, you don't see big wild swings, on a year over year change, or 6-month change like this. You can, but not typically. The 2-year piece, though, can kind of give you a lot of information around inflation in particular. And our read of this is that inflation expectations have risen over the 6-month period. At the beginning of the year, we'll talk about it a little bit later, we'll show kind of the expectations. There was pricing in rate cuts. Now they're pricing in rate hikes. And important to keep in mind is that the Fed generally operates in a path dependency nature. If market participants, it's possible to use options and other products to express a view on where you think rates are going to be in the future. And so if market participants think rates are going to go up, they generally follow a path dependency of the Fed moving in increments of like 25 basis points. And so if the Fed wants to do 2 cuts, it means they have to do one before they can do 2. That's why today, Parker, is a really interesting day. They chose not to. So it'll be interesting to see how the market participants' reaction to this shakes out towards the end of the year. Are we still going to be expecting 2 cuts? Is that going to be faster? Is there going to be 150 basis point cut, and they'll kind of shirk some of that path dependency language that I was anchoring off of? We'll see how those things play out. But market participants are telling us that over the medium term here, that 2 to 5 year period, they do expect inflation to be a little bit higher. If they're going to lend to the government, right, they're going to buy these notes, then they're demanding a higher premium for doing so, generally reflecting greater inflationary risk.
Yeah, and yeah, more to come on the Fed through the end of this year. I mean, it's going to be very interesting to see what they do. And I wanted to, Michael, spend a couple minutes here on, we mentioned Iran a lot, and really the biggest driver of risk from this conflict in Iran, and it's unfortunate, but it's very frequent. We see international relations, we see war. I mean, this is just a part of life and a part of being an investor. These things happen, and they will continue to happen, unfortunately, in the future. But really, the primary driver of risk has been oil prices. And we, as consumers, can see the price of a tank of gas driving around every single day. And so when we see those prices go up, we are worried about inflation, and it is right in our faces all the time. And so what we saw with this war and is really just the price of oil jumped up. And I think, I heard you say too, the market was leading into that a little bit. I mean, as some of these tensions were rising, we saw some of these, tankers kind of filling up and getting out of the Strait of Hormuz, right? And getting out of Dodge a little bit.
That's right.
Right. And so then it happens, the war starts. I won't call it a war. The conflict starts, and then we see the price of oil jump up, and we see it very volatile. But it's come down quite a bit since then. So yeah, Michael, I guess what are your deeper thoughts on this? We're seeing a ton of volatility in the oil sector. What's really driving this, and I guess how are we as consumers supposed to deal with this?
Yeah, absolutely. I mean, oil remains a key commodity, a driver of global economic activity, important for many nations of varying degrees. Look at like a nation like India as a net importer of oil to a great degree. Like this impacts them differently than the U.S., which is a net exporter. But we are all price takers in a sense on oil, and so this matters to us. This matters to every investor. It just as a note too, I was an energy investor for 6 years in a prior life, and it's kind of hard to see here. Parker, I should have called it out for you a little earlier, but right at 2012, that's when I joined. And then if you're looking at that left chart there, you can see that's pretty much near an all-time high of Brent, around 120 a
Nice.
barrel. And then I left in 2016 around one of the $20 a barrel periods there. So I had an unpleasant run in the energy space here. That volatility was generally one directional to the downside there. But the nature of volatility in oil is that it is quite high. It reflects global supply and demand, and it does reflect things like geopolitical tensions, new supply coming on. If you guys follow this, Guyana has found one of the largest oil reserves in the world. You know, it's one of the fastest growing countries as a result of that by GDP basis. So, you know, it is volatile in a sense here. What we actually saw, though, through the conflict was that the shock was, this is actually a relatively contained version of it. If you think about the duration of the spike here running up to the conflict on the right, you can see oil prices ticking up from 65 towards north of $70 a barrel as we observed tankers in the region and suppliers in the region offshore supply and store it basically on tankers at sea. And so prior to the conflict, there was actually a tremendous amount of supply out in the market or in transit or held in strategic reserves by specific nations. And so, yes, there was a run up in terms of price, but also we were able to deliver and meet demand relatively quickly as these tankers were delivered. They made it to their final destination. Nations made decisions to strategically draw down on those reserves. Notably, China was not buying, during the real heat of this conflict. And China is a large buyer of oil on the market writ large. And so these are not things that can persist forever, right? You only have so many tankers at sea. The strategic reserves are not a finite resource. It is costly to store oil. I don't know if anybody's actually thought about this, but oil, it smells terrible. It produces toxic gas, and it is heavy. It is a very difficult thing to store indefinitely, difficult and costly. And so these are not behaviors that can persist forever. Now, thankfully, heading into the end of the quarter, we saw renewed optimism for reduced tensions in the region, driving down some of that. There were a couple ships moving through the strait. That was fantastic. Since then, between 6:30 and 7:29, where we are today, tensions have ramped up a little bit. And so there is renewed conflict. The rhetoric is hotter again. And I think that's going to be the nature of this conflict for the foreseeable future. There's going to be gives and takes. There's going to be progress made. There's going to be some walking back. And there's just going to be like that, notably, up into, this is a midterm year for U.S. And so is kind of some of the political machinations around moving the conflict forward or moving towards a resolution will be reflective of kind of the midterm election. You may ease into the midterm election and it may ramp up again. Who knows? There's a wide range of outcomes in that, but reflective of the current situation. Market participants, if you look at the futures curve for a barrel of oil, at the end of the year, they're saying about $80 a barrel. Right? It's about 90 right now. It hit 100 a little bit earlier in the month, and it's come down to about 90 right now. So in terms of, Parker, the range of outcomes, what we think about, right? Like, how do I think about, wealth management context? I know this is a volatile asset. I know it's important for my everyday life, and I know it's important for my investments, but it does feel, okay, so I have to communicate in a range of outcomes here. And the range of outcomes so far has been relatively contained, and it does seem to be that that will be kind of the nature of this going forward.
Right. Yeah. I mean, I love everything you said there. And I want to just take us, kind of a step back to the Fed and really the Fed has that dual mandate. And so for folks on the call, just a reminder that the Fed really has two jobs. One, they want low and consistent inflation, and we want a fully employed workforce. So we want low inflation and low unemployment. And so some of these risks to, what rising rates, what might lead to rising rates might be inflation, which is led by a lot of that might be by oil. But want to change gears here to the employment picture. And we've had a good year of strong jobs growth throughout the year, but it looks a little different depending on the sector, right? We've got some growth in areas where we need people, right? Industries like education, health services, leisure, hospitality, where we actually need bodies there. Construction, AI isn't going to be building buildings and putting hammers and shovels in the dirt. But there have been other areas impacted a little bit by maybe impacted a little bit by AI. One of it being our industry, Michael, financial services. So maybe we need to
Yeah, that was a little
start
worrying.
learning how to code. Yeah, that's good to know. But where I guess, especially for some of our younger clients or children of clients that are in school right now. I mean, there is real concern about AI taking jobs. I mean, where do you think this is right now? And I mean, what is the effect of AI on employment right now?
Yeah, absolutely. I think in the long pull, right, which is probably one day longer than you're willing to give me, if you ask me to define what long term is. But in the long run, I think that there will be an impact on jobs in AI. Now, are you familiar with the doorman fallacy, Parker? You heard of this one
I'm not.
before?
No.
All right. So everybody thinks that being a doorman is an easy job, right? What do? You just open a door. But if you think about that, if you're a doorman in a New York City building, they provide many different services. A machine could just open a door. It has a little sensor. It opens a door for you, and then it closes. A few seconds later, whatever it might be. But they don't provide that sense of security. They don't provide the human interaction. They don't provide help with your groceries. They don't discourage unwanted behavior, such as like loitering or graffiti outside your building. The doorman actually provide. It's a much more complex job than most people would give credit for. It's not saying that it's rocket science here, but it's more than just opening a door. So many entry level jobs that quote unquote are at risk for AI probably fall into this fallacy as well, where they're more difficult to automate or get rid of writ large than we give credit for. I think we'll start to see this change at some point. I don't know that a year over year change like this is necessarily communicating that. This might be what it looks like, though, in the sense of education and health services. So I've got a 2-year-old and a 4-year-old. I care very much about education. And then, like a broader point around going back to the other side of the mandate, not to jump around too much from the Fed, but inflation, like education and health services, the inflation rate on this sector here is different than the inflation rate, overall, right? And the employment opportunities there, kind of reflect, some of the growth in the sector as well. But back to the point about jobs, I don't want AI teaching my kids or taking care of my elderly parents. I don't know what that looks like. That doesn't feel like a world that all of us want to subscribe to writ large. I don't want to speak for everybody here. Maybe you do like that, and that's fine. But I think most people believe that human interaction, that human component, is an important part of features like education and health services. So are these more durable to AI changes? Potentially so. Other activities like financial activities, I think I think I'm good at what I do, and I like what I do. I'm reasonably good at it. Dose of humility. I think I'm reasonably good at it. But I think that the financial sector is ripe for AI disruption, and we see them lost jobs year over year, writ large. Other, going back to the more positive side, leisure and hospitality. If you guys are taking a vacation anytime soon, you check in at a hotel. Do you want to go and do it at a kiosk necessarily and get your key that way, or do you want to, have somebody open the door for you, greet you, welcome you into your nice hotel, show you where the elevator is, maybe help you with your bags? Those are jobs that are difficult necessarily for AI to automate. So I'm not saying these are all the best jobs. I'm not saying these are all fantastic jobs. I'm just saying that the period of transition is going to be one of probably a little bit longer, a little bit more choppy than an AI executive wants you to think. And then a broader note, Parker, before I don't want to get on a soapbox here. You'll hear executives, McDonald's and Meta and a range of sectors communicating, oh, we're laying off jobs due to AI. We don't need as many jobs now. To be fair to the AI players, they've been doing that for years now. ChatGPT rose to prominence in what was it, 2022, and the trend of layoffs, for many of these companies has been a little bit longer than that. For those that are in the AI sensitive, area of the market in terms of disruption, and so I think there is some narrative by executive leadership around quote unquote AI. We need fewer jobs due to AI. That's really just a return to profitability and a focus on earnings and some of the pressure that they have to deliver on the earnings piece and control what they control on the cost. Not so much that AI represents a technological shift that they are now able to capitalize on. It just hasn't. They've just been behaving the same way for a longer period than AI has been a mature tool for them to use. So I'm sure there's some element of truth to it, Parker, but yeah, you and I in our seat, we have to be skeptical to some of that type of commentary there. Like they're communicating to their shareholders. They're trying to sound really smart. Oh, we're taking care of AI and we're cutting jobs because we don't need them anymore. There's
Yeah.
some that doesn't quite pass the smell test. It's 10% true, 30% true, something on that order of magnitude, but they've been cutting jobs for a little bit longer than, you know, Claude has been around, or, you know, or the best models have been available to them.
Right, exactly. You know, maybe AI is an excuse to cut jobs. So, and to your point too, Michael, I'll just make one last point. Is this reminds me a little bit of the tech bubble in the late '90s, right? I mean, what were we promised with the dot coms, right? It was okay. It's going to change the way we communicate, change the way we shop and buy and purchase. And for the most part, we were right. You know, they're right, but it just took a long time to get there. And so same thing with AI. I mean, these things are probably going to happen. It just might take some time to adapt. And then changing gears real quick. I won't spend too much time on this slide here, but really wanted to show that the forecast for the Fed throughout the year has changed dramatically. And what we thought coming into the year, where we were going to see a couple cuts, due to this Iran conflict and some of this inflation concern has really led us to more of a hike situation. And actually today, even though the Fed held rates steady, we saw that 3 governors actually voted to increase rates. So there is definitely some noise happening. And you know, I'd be willing to bet that the next move in the Fed will not be a cut. It will likely be a hike, Michael. I mean, it's just with
Yeah.
where inflation is and just where things stand today. I know Fed Warsh just got on the podium today, so I know folks will be listening closely to what he has to say.
Yeah, I think I'll be interested to read the transcript after the call and see if anything I'm about to say is in just in total disalignment with whatever he's about to say. But at the same time, I'll take the opportunity on this slide because we kind of talked about some of the Fed fund rates and the market expectations, and I want to beat the topic to the end. But I will say, importantly, let's take a look. Let's take a longer poll. Over the last few years, we've had several inflationary shocks. We have had, I think, 5 of the last 6 years, there have been significant macroeconomic events that have been writ large inflationary. There was COVID, there was the conflict in Ukraine, there was a regional banking crisis, there were tariffs, and then now the conflict in Iran as well. All of these are inflationary events, and inflation has been running above the Fed's target of 2% for a persistently long time. And each of these in isolation, maybe you can kind of get through one of them, but you know, they're stacking. And so the Fed is concerned necessarily that inflation runs away from them and they can't really get it into target here. If you look at kind of like all the data around employment and actually much of the components of CPI of inflation, the case for hiking is difficult, other than it seems persistently higher than above their target. And so
Mhm.
it's reasonable to expect hikes. Now the path of that is relatively wide and uncertain here, but just the durability of inflation over the period is probably contributing more than any one component of CPI. But bringing that up gives me the opportunity to talk about, again, the importance of a wealth management context. We don't exist in a vacuum of just asset management, agnostic to our bespoke needs, tastes, and preferences. Parker, one of the things I love about working with you is that we get to have real conversations about what, you know, inflation means for this subset of clients or whoever it might be, right? Which is just aligned to their goals. Again, I've got my favorite subject, my children, 2 and a 4-year-old. I care about inflation on education, because that is a primary expense that I have to plan for over the next, gosh, who knows, maybe they go get their MBA and I want to chip in on that. Let's just say 25 years, right? Maybe they want to be a CFA like Parker, and then, you know, I'll try and chip in on that as well. I saw those textbooks there. The textbooks inflation is crazy. You know, and then my father's getting older as well, and I want to plan for his long-term care as well and make sure that I can contribute to those. Those components of inflation are different than the 2.6 number that's not on the slide here, but that's the last print that we saw on inflation. It was about 2.6. You know, those numbers are very different and higher than the component of aggregate inflation, which is just a basket of goods, you know, for the nation. If you live in a different part of the country, inflation in Atlanta is different than inflation in San Francisco, right? So we're trying to represent inflation, discuss it using one number because that's the best tool we have available to us. But the value of a planning-led investment philosophy, which is aligned to your goals, is that it can be reflective of those bespoke considerations. That's where all the art and science, that's where they meet. Right? The good investment philosophy, good investment planning is a recipe for really good outcomes, even when something changes pretty quickly year over year, like Fed expectations, the Parker that you're presenting now, even when they change relatively quickly, a good plan is, I won't say immunized that, it's too strong of language, but like whatever word is 10% less than immunized, that is the benefit of a good investment philosophy coupled with planning reflective of those bespoke needs, tastes, and preferences.
Absolutely. And listen, it's a great reminder too that when we create plans, as soon as we print that plan, it's already outdated. Our planning is a constant, ever growing. I mean, it's why we name the company Evolve. I mean, we are constantly evolving in our needs and our goals and our wants and our wishes. And that's really what planning is. And so I know we're running a little over time, but I want to cover just a couple things, a couple trends here that we're seeing in the market, especially with the AI trade and really our big tech names, our friends, the Magnificent Seven. And what we've been seeing, this is a chart we've been showing clients over the last couple of years, is 2023, 2024. Great years for the Magnificent Seven. I mean, we see NVIDIA with returns over 225%, 175% in 2024. These are fantastic years for not only these stocks, but just this like cohort of stocks, I guess, kind of all moving together. 2025 was a little bit weaker. And then we see what's happening here in 2026, where these seven names really are not moving together anymore. We're seeing the correlation is not there so far in 2026. Really, just one name, Google, has outperformed the S&P 500 so far on the year. So what used to be the market darling has now changed a little bit. And Michael, one of the things that we talk about a lot with our clients is the value of diversification. We don't want to have all of our eggs in one basket. We don't want to be over our skis in one company or one part of the market, because what seems like a surefire trade, I mean, these things can change over time. And so that's where we've been working with your team to help build out these well-diversified portfolios to help reduce the risk of that one company missing earnings or that one sector having a headwind all of a sudden hit them. I mean, we want to spread our risk across multiple asset classes.
Yeah, I couldn't have said it any better. I'll be relatively brief in the interest of time and just say, when we take risk, we want to take compensated risk. And because you can diversify away from the risk of the idiosyncratic risk of holding individual names, the market, quote unquote, as an academic would put it, doesn't compensate you for taking that risk. And this year, it represents that uncompensated risk that you're taking there. You can be subject to considerable drawdowns. When we take risk, we want to be compensated risk.
Exactly right. Yeah, and so that's where, again, we bring it back to planning. We want to know. I had a meeting this morning and we talked about why take extra risk if we don't need to. That's where the plan will drive eventually drive the portfolio. And I just want to again, Michael, just talk briefly. What's the why behind this change with the Mag 7? And we've seen this rotation from some of these, all the companies that we just mentioned. NVIDIA, Facebook, Microsoft. A lot of these companies were Facebook or Meta in particular, very, they don't have a lot of assets. They're not spending a lot of money. I mean, this isn't Boeing where they're building planes every year. I mean, it doesn't cost a lot to put a web. It's more than just putting a website up. But now all of a sudden,
not much more. Yeah.
Right. But then I'm remembered of that interview with Zuckerberg and Trump, and he's like, yeah, we're going to spend. What was the number you said? Like $100 billion or $200 billion on AI. I mean, it just seems like everybody is now, there's this race to spend and put these data centers down. I mean, this AI trade, it's a race, but it's going to take real it's going to take billions of dollars to win this race. And so I think that might lead in here, Michael, of kind of why we've been seeing this rotation of, we were all excited about the companies that were spending the money, and now we're kind of excited about the companies that are receiving the money with this trade. Did you have any more thoughts on that?
No, I think that's exactly right. The last few years that you had just shown on the prior slide shows kind of the spenders being rewarded for doing that. And Nvidia is kind of an outlier in that in a way, but many of them were the hyperscalers, right? The big spenders. And now who's benefiting? It's the Micron, the Intels, the Broadcoms. Like it's a different set now. And I think that when we talk about the broadening of the market earlier, right? It's a little cliche to call it the picks and shovels trade, but like it's like the gold rush, right? Like who got rich going out in 1949 out to San Francisco, out to the California. It wasn't the gold miners, it was the guys selling picks and shovels along the way. We're seeing some of that now. We are seeing that. And then on the next slide, you have, if we can go to that slide if I'll just pick this up. You talked about the huge scale that we're talking about here. These companies are structurally changing their balance sheets from very asset light, IP driven companies to very asset heavy companies. They are structurally changing. The race is on. They've grown their capital expenditures by over 4 times since 2017. Huge amount of spend. Now, there's 2 types of CapEx writ large. There's growth CapEx and there's maintenance CapEx. If you're a public utility, you're driving along, you see the utility guy, the lineman managing the lines. He's, I don't know what he's doing up there. He's doing something. That's maintenance CapEx. They got to do that just to keep the power flowing. Growth CapEx, you expect to get a return on. And we're seeing that in earnings, right? We are seeing some really strong earnings and pricing power from these companies and some scale, between revenue and net income on their income statements. So we are seeing that. But at the scale at which they're spending CapEx, they need even more. The next slide, actually, Parker, shows that scale in great context here. I'm just going to keep running. You jump in if you think that I've said something crazy.
No, you're on a roll. Keep it rolling.
This is representing computer equipment investment as a percentage of U.S. GDP. U.S. GDP is on the order of magnitude of $35 trillion, and it's going to be something like 1% of that in terms of just computer equipment investment. Project that out a couple of years. Work from Goldman Sachs shows that number might be about 3%. So you're talking about spending $1 trillion just on AI-related CapEx. The scale of this investment is very difficult to fathom. For example, the entire GDP of the Netherlands is something like $1 trillion. The entire GDP of Taiwan is something like $1 trillion. We're talking about investment into this theme on the scale of countries. It's relatively unprecedented, and whether or not there's a return on that is the big question for equity investors, Parker.
Right. Exactly. I mean, it really is a lot of spending. And I do want to just jump ahead here, Michael, and really round out our conversation. We talked about a lot. We talked about the quarter, great year for market, or great quarter for markets so far, great year for markets, just despite some volatility. But there's risks out there, right? It's what's the Fed going to do through the end of the year? Michael, you just hammered home. There's a lot of spending and uncertainty in this AI trade, and there's billions of dollars going in the ground. Are we going to be compensated? We talked about in our portfolios, are we compensated for the risk? Are these companies going to be compensated for the risks that they're taking? But rounding this out for the folks on the call, our clients, our plan participants, when we talk about building portfolios, we're constantly preaching diversification. Diversification is the cornerstone of a well thought out portfolio. It's that warm blanket that you can put over the portfolio to help reduce the volatility. And if we can help reduce volatility, then we're hopefully reaching our outcomes, which typically is retirement. That's typically our number one outcome. And despite some of this volatility that we see in equity markets in the short term, this is a great reminder of how Q1 can be very different from Q2. But taking a look back at some of the data that Jeremy Siegel's team has put together here, going back to the equity markets to 1800, we actually see how stocks in the long term can actually be quite smooth. Now, you have to take a really big step back to see that. And I understand that a lot of us on the call aren't Rip Van Winkle investors. We'd love to make an investment and then go to sleep for 20 years and wake up and we have a great retirement balance and we never had to worry. But, a lot of this is we're constantly being fed with news and content and fear in our faces all the time these days. And so and I'll share just a quick story. I just met with a couple folks, and they both worked at the same company, and one guy made a decision in 2008, and things changed, and then the other guys kind of stayed invested, and very different outcomes. And so, you know, we can see how fear can sometimes lead us to make poor decisions. And so we never want to make emotional decisions with our portfolios or with money, because it can lead us down a bad path. And so that's what we are here for, is to help you all with those decisions, and help take some of that emotion out of it, help take some of that fear out of it, help sift through some of the noise that, you know, I'm looking at Bloomberg right now, sift through some of that, so we can help you all reach your goals. And so, Michael, anything else that you want to add on that?
No, that's such a succinct summary. Thank you, Parker, for having me here today. Sorry, I got really excited. The extra time's on me. I was just having such a blast.
You're good, man.
I lost track of the clock there. So I really enjoyed the conversation. Thank you again for having me on.
You're good, Michael. Thank you for being on with us. We really enjoyed it. And then for the folks that stuck around, thank you. As a reminder, this will be recorded, and we'll be posting this on our website. So if you want to watch it later or share with a friend, that's where you can find it. So thank you all again. And Michael, thank you for the last time.
Thank you.
Yep. Take care, buddy.